Financing full-service hotels and a guide to hotel loans and understanding the underwriting and the capital strategy involved. In financing a full-service hotel is going to be fundamentally different from financing a typical office building or a retail center or industrial property or a multifamily asset. And a hotel is both commercial real estate and an operating business rolled into one. And that distinction changes how lenders are going to evaluate the transaction. So when you're financing full-service hotels, lenders aren't simply asking what the property is worth or whether the building is occupied. They're also going to analyze the hotel's operating performance and the market demand and management and your franchise affiliation, your competitive market set, your capital needs, but also the borrower's experience managing hospitality assets. And for commercial real estate investors, considering the acquisition, refinancing, renovation, or repositioning of a full-service hotel, understanding these underwriting factors before approaching lenders can help make a significant difference. So, what is a full-service hotel? Well, full-service hotels generally provide substantially more amenities and services than limited service properties. And depending on the property, these may include a restaurant and a bar, or room service, or conference and meeting facilities, or a banquet operation, or fitness centers and pools, or valet or concierge services, significant food and beverage options, but also large event spaces. And these amenities can create additional revenue streams, but they can also introduce additional operating expenses and complexity for each loan. So that's one reason that full-service hotel loans will require a little bit more specialized lens in the underwriting process. So first, let's talk about why hotel financing is different. And traditional commercial properties typically rely on contractual lease income, where hotels effectively re-lease their rooms every night. And that means revenue can respond quickly to changes in business, to travel, to tourism, to conventions, also local employment, economic conditions, the competition in your market, but also consumer spending. And for that reason, hotel lenders frequently examine hospitality-specific metrics. So occupancy, the percentage of available rooms that are occupied. There's a metric called ADR, average daily rate, and it's the average revenue generated per the occupied room. There's also RevPAR, a revenue per available room, which is a key measurement combining both occupancy and room rates. And NOI, net operating income, and that's the property's income after the operating expenses, but before debt service and certain other items like tax. DSCR, debt service coverage ratio, and that's the relationship between qualifying cash flow and required debt payments. And a strong hotel loan request should demonstrate not simply what the property is worth, but how reliably the hotel can generate enough cash flow to support the proposed debt. Financing options for full-service hotels. So there isn't one universal hotel loan program, and the appropriate capital source is going to depend on the property, the sponsorship, the business plan, the leverage, the cash flow, the loan amount, and the exit strategy. Conventional bank and credit union financing. And banks can be an excellent source for stabilized hotel properties, particularly when the borrower has strong liquidity, experience, and maybe even an established banking relationship. And that lender may evaluate both the property's historical operating performance and also the strength of the guarantors. SBA hotel financing. So for qualifying owner-operated hotels, SBA 7A and SBA 504 provide a really attractive financing structure. And eligibility and structure are going to depend on the specific transaction and the SBA requirements. So borrowers should determine eligibility early rather than assuming that every hotel acquisition will qualify. CMBS hotel loans and CMBS financing can be another option, particularly for larger, stabilized hotel properties. And these loans are generally underwritten primarily around the property's ability to generate sufficient cash flow. But borrowers should also carefully evaluate prepayment provisions and reserves and reporting requirements and servicing considerations. Bridge financing. And bridge loans can be particularly useful when a hotel has strong underlying investment thesis, but right now doesn't yet qualify for permanent financing. So some examples would include hotels that are, say, undergoing renovations or rebranding or management change or a franchise change or an operational turnaround, or if they're dealing with a PIP, a property improvement plan, or if there's some occupancy stabilization issues. And the critical issue with bridge financing is the exit strategy. Investors should understand what operating performance must be achieved to be able to refinance out of that loan and into permanent debt. But there's also private and alternative capital sources, and some hotel transactions just simply don't fit conventional underwriting boxes. And that's where private lenders and debt funds and structured capital providers, as well as other alternative lenders, may provide additional solutions, particularly for transitional or complicated transactions. And the trade-off there is it can include higher capital costs, making the investment business plan and exit strategy especially important to getting the financing. So let's talk about the importance of a hotel flag. And brand affiliation can have a significant impact on hotel financing. And a recognized franchise may provide lenders with historical performance data and reservation systems and marketing infrastructure, but also brand standards and an established customer base. But lenders also need to understand the costs that are associated with that flag. So those can include franchise fees and required renovations to maintain brand standards, or reserves management requirements, and potentially property improvement plans or PIPs. And a substantial PIP can materially change the economics of an acquisition. The PIP can change your entire capital stack. So imagining acquiring a hotel for $20 million. But if the franchise requires another $4 million of improvements, the financing conversation isn't really about a $20 million acquisition anymore. And it is about the capital that's going to be required to execute a $24 million business plan, plus the transaction costs and potentially working capital that may be needed. Now, investors therefore need to understand how much of that acquisition and renovation budget and PIP cost and closing costs and working capital the lender is going to be willing to finance. And that makes loan to cost as important as loan to value in many transitional hotel transactions. So let's talk about what hotel lenders do look for. And hotel underwriting is really multifaceted, but several issues routinely receive significant attention. And the biggest is historical cash flow. And lenders want to understand how the hotel has performed through operating periods, traditionally 3 years and year to date. Borrower experience. And experienced hotel sponsors and operators can materially strengthen a transaction. Liquidity. Hotels can experience substantial fluctuations in cash flow, making post-closing liquidity important. Market performance. And lenders may analyze competing hotels and demand generators and supply pipelines, but also occupancy, ADR, and RevPAR. There's also brand and management. And the franchise and the operating team can materially influence the lender's perception. Property condition. Any deferred maintenance or any upcoming capital expenditures need to be identified and properly funded. Debt coverage, and ultimately the property's qualifying cash flow needs to support the proposed loan structure. And that's why we need to build the financing strategy before you close. And one of the biggest mistakes that I see hotel investors make is treating financing as something to solve after identifying the property. And the debt really should be incorporated into the investment strategy from the beginning. So before moving forward, investors should understand what loan proceeds could realistically be supported by this asset. And in turn, how much equity is going to be required from the sponsors? And how will a PIP or renovation program be funded? And what operating reserves will the lender require? And what happens if stabilization takes longer than projected? And what is the long-term refinance or disposition strategy? And a lower interest rate isn't necessarily the best financing solution if the structure doesn't really support the property's business plan. So let's talk about why a broad lender marketplace matters. And hotel lending appetite can vary significantly among capital providers. And a bank that likes one hotel transaction may have little interest in another because of its geography or brand, or leverage or loan size, or property performance, or the sponsor's experience. And that makes access to multiple lending sources particularly valuable for hotel investors. And through me, Bill Rapp, the CommLoan Empower Program will enable our borrowers to evaluate commercial real estate financing across a broad lender marketplace, rather than assuming one lender's credit box represents the entirety of the capital market. So final thoughts. Full-service hotels can offer compelling investment opportunities, but the financing is specialized. And the strongest hotel loan requests combine quality real estate with sustainable operating performance, experienced sponsorship, sufficient liquidity, a credible business plan, and the appropriate capital structure. So whether you're purchasing or refinancing or renovating or repositioning a full-service hotel, the objective shouldn't simply be to find a lender that's going to be willing to make the loan. The objective is to identify financing that's going to align with the property's current performance, but also your long-term investment strategy. And that's what I'm here for. My name is Bill Rapp. I'm part of the CommLoan Empower Program, and we connect commercial real estate borrowers with financing solutions designed around your deal. Thank you for watching. You can visit my website at billrapp.commloan.com. I appreciate your time. You have a good day.